Okay, Assalamualaikum and a very good day to our lecturer, Assistant Professor Zulaila binti Zakaria. We are from Section 3 and today our group will be presenting assignment 2, which is the financial plan and business valuation for our course, Business Finance 1. Our group consists of 6 members, Aina Bakis, Jumi Irdina, Shazlin Arisa, Nur Farzana, Raviatun Nabila, and Mayamin. The focus of our report is our client, Mr. Haziq Johari, the founder of Combinio under HZF Resources Sdn Bhd. Following our preliminary analysis of Combinio's operation at Terminal Bersepadu Gombak, we have developed a 5-year cash flow estimation and a formal business valuation to assist him in navigating current cash flow pressures and planning for future expansion.
The store emphasizes innovative food items like matcha drinks, pastries, and unique flavors, supported by efficient inventory management and cashless payment system. With its modern branding and customer-focused approach, Convenio positions itself as a lifestyle-oriented convenience store that delivers simplicity, speed, and quality for everyday needs.
There are several issues faced by Combinio since opening. The first one is operational challenges. Combinio faces operational problems because the number of buses is much lower than promised. The terminal was expected to be busy, but fewer buses mean fewer customers. This affects daily operations of the store and sales. Next, low customer turnout. Even though the terminal looks modern and attractive, not many customers visit the store. Most passengers are in a hurry and do not spend time to shop, which causes low sales. Other than that, low market acceptance. Customers are more prefer well-known stores like 7-Eleven, Minus, and others. Since Convenio is still new, many customers do not trust it yet, making the competition difficult. The last one is low brand awareness. Many customers do not know about Convenio. They are unaware of its product and concept, which reduce interest and store visits.
To address the challenges faced by Convenio, several critical aspects are identified to support the company's growth. The first strategy is targeted promotions and incentive. This includes offering opening discount, trial promotion, limited time offer, and loyalty programs. These strategies aim to attract first-time customers, encourage repeat visits, and help stabilize demand in a competitive market. The second strategy is content marketing. By creating engaging and informative content on social media platforms, Convenio can increase brand awareness and strengthen its brand identity. This approach helps build customer trust, educate customers about the store's unique offerings, and differentiate Convenio from established competitors. Overall, these strategies focus on improving customer engagement, increasing visibility, and supporting long-term business sustainability.
I will explain the cost of capital for convenience store. Convenio is a privately owned business and is fully financed by the owner's equity. Since the business is not publicly listed, there are no market data available. So we use the capital asset pricing model or CAPM to estimate the cost of equity. Based on this CAPM calculation, the cost of equity is 5.59%. This rate represents the minimum return required by the owner to compensate for the business risks involved. Next is the weighted average cost of capital or WACC. Since Convenio is financed entirely by equity and has no debt, the WACC is equal to the cost of equity. Therefore, the WACC for Convenio is also 5.59%. Any return above this rate indicates value creation of the owner, while returns below this rate indicate poor performance.
Okay, next I'm going to proceed with the business valuation process. Business valuation process is a structured approach used to estimate the economic value of a businesses. So there are 6 process of valuation, which is understand the business industry. As for Convenio, it is a convenience store that have a business model with a competitive environment, and it is located in the terminal Bersepadu Gombak. Next is to determine the purpose of valuation. So and analyze financial position performance of the business by reviewing the revenue, operating cost, and also the cash flow. Other than that is the accessories and growth potential, such as competition from other businesses, and also the reliance on the foot traffic. By doing all this, we can come up with the suitable valuation method and also estimate and interpret the business value to our client. So I will proceed with the method of valuation. There are 3 methods of valuation, which are asset-based method, income-based method, and also market-based method. For the asset-based method, it is a value equal to total asset minus total liability. It is focused on the tangible asset and suitable for the small businesses. Income-based method is a value businesses based on the future income and cash flow, include the capitalization of earning, discounted cash flow, and also it is suitable for going concern business. So for the income-based method, which are the method that we apply in our group assignment. Also, the third one is the market-based method. It compare businesses with the similar company. It use a valuation multiply and limited to private company due to the lack of.
Moving on to the next part, which is our key assumptions to calculate SOPL and SOFP. First and foremost, sales are expected to increase by 10% each year, which leads to higher inventory levels, purchases, freight in, and maintenance costs. Next, depreciation is calculated using the straight line method over 8 years, while operating expenses such as salaries, rental, utilities, and marketing increase by 2.2% annually due to inflation, with the POS subscription fee remaining unchanged. Other than that, the business employs 2 full-time workers and 1 part-time worker, and salary expenses increase gradually over time. For the soft fee calculation, property, plant, machinery, and furniture are depreciated using the straight line method, with furniture already used for 2 years. A bank overdraft is utilized starting from year 3 as cash declines. Owner's capital remains unchanged and return earnings decrease. Furthermore, some assets are purchased on credit, resulting in accounts payable. Overall, the business records a net loss every year, and the net loss is expected to increase in coming years due to expansion and rising costs.
Next, we go to cash flow analysis part. The cash flow consists of three main components, which is the initial investment, operating cash inflow, and terminal cash flow. The initial investment shows the business require an initial investment of 48,000 ringgit in year 0 for equipment such as cake display, high-speed oven, chiller display, open chiller, and coffee machine. After adjusting for change in working capital, the net initial investment amount to 47,340 ringgit. The working capital are calculated by current asset minus with current liability. For operating cash inflow part, revenue is projected to grow steadily from 144,000 in year 1 to 242,892 ringgit in year 5, driven by business expansion and increased customer awareness. Operating expense including utilities, salaries, transportation, rental, advertising and maintenance are expected to rise gradually due to inflation for 2.2% each year and operational needs. Depreciation remains constant at 7,000 ringgit annually, calculated using the straight line method. After accounting for taxes and adding back depreciation, operating cash inflow improved significantly from a slight negative 460 ringgit in year 1 to 70,468 ringgit in year 5, reflecting strong growth in profitability. Lastly, terminal cash flow. At the end of year 5, the business recovers 50% of its working capital, amounting to 47,670 ringgit. This recovery contributes to a total net cash flow of 120,138 ringgit in year 5, indicating a positive return on investment over the project period.
Okay, next we'll move to the valuation of business. First, let's look at our initial investment, that is net present value, IRR, and payback period. Our initial investment of 47,340 covers new equipment and working capital. Despite minor losses in the first year, the project generates strong inflows, culminating in over 120,000 by year 5, which includes the recovery of our working capital. This results in robust MPV of 109,373.84 cents. Because this figure is a positive and far exceeds our 5.59 WACC cost of capital, it proved the project will significantly increase the owner's wealth. The internal rate of return, our IRR, the project achieved an IRR of 40.28%. When we compare this to our hurdle rate of WACC, which is 5.59, we see a massive margin of safety. This means the expansion remains profitable even if we face unexpected operational costs or rising interest rates. From a profitability standpoint, an IRR this high makes the project exceptionally attractive to the owner. Finally, we evaluated to the payback period to understand our liquidity risk. As shown in our cumulative cash flow table, the initial investment is fully recovered in 3.29 years. That means that by the first quarter of the year 4, the business has paid back all the expansion costs and enter a pure profit phase. In conclusion, with a high NPV of 40% of IRR and a recovery in just over 3 years, the financial data strongly supported the decision to proceed with the expansion. Thank you.